The Federal Reserve's latest stress test results are out, and these signal a massive shift that could reshape your investment portfolio. For the 11th year in a row, every single one of the nation's 22 largest banks passed with flying colors, proving their resilience against even the most severe economic shocks. This isn't just a win for the banks, it's a potential bonanza for you, the American shareholder, opening doors to increased dividends and stock buybacks. This year, the Fed threw a hypothetical, severely adverse scenario at these financial giants: a major global recession with a 10% unemployment rate, a 30% plunge in commercial real estate prices, a 33% drop in housing values, and a 50% fall in stock prices. Despite projecting a staggering $550 billion in theoretical losses across credit cards, commercial loans, and real estate, these banks demonstrated they could absorb the hits and still maintain capital levels far above regulatory minimums. We're talking about an aggregate common equity tier 1 or CET1 ratio of 11.6% for the industry, well above the 4.5% required. This robust capital strength means these institutions are well positioned to continue lending to households and businesses even in a downturn. But here's where it gets interesting and a little controversial. While the banks passed, the 2025 stress test itself was notably less vigorous than in previous years. The Fed's hypothetical scenario had milder assumptions for unemployment, real estate declines, and stock market drops compared to what they tested in 2024. For instance, the 2024 test envisioned a 40% decline in commercial real estate and a 55% drop in stock prices, significantly harsher than this year's assumptions. The Fed explained this shift by citing, quote, unintended volatility in prior results and a global economy that has weakened since last year. They're also seeking public and industry comment to adjust future tests, signaling a potential move towards more predictability, or as some critics argue, less rigor. This perceived leniency has sparked debate, with some advocacy groups claiming the tests are becoming stressless, and that providing test details in advance could allow banks to game the results, prioritizing shareholder payouts over systemic safety. A significant omission from this year's rigorous testing was bank exposure to private credit. This rapidly growing asset class now sits at a massive $2 trillion market, and even some Fed researchers have noted its alarmingly fast growth, with the Federal Reserve Bank of Boston identifying it as a potential systemic risk under severe adverse scenarios. Yet there was no specific wording or methodology in this year's test focusing on private credit or private debt exposure. While the Fed did an exploratory analysis suggesting major banks were generally well positioned for private credit losses, this analysis was entirely separate from the official stress test results. This blind spot raises questions for some observers about whether the tests are truly gauging all potential risks. However, from an investment perspective, this less vigorous approach, combined with ongoing regulatory changes, is largely seen as a positive catalyst for banks. The Trump administration's push to ease banking regulations is amplifying this positive momentum. Key changes like the potential easing or elimination of the enhanced supplementary leverage ratio, or ESLR, and the Fed's proposal to average stress test results over 2 years could unlock billions in capital. The ESLR has long been criticized for penalizing banks for holding low-risk assets like treasury bonds, and its removal could significantly boost return on equity and reduce compliance costs. The 2-year averaging proposal is equally crucial, smoothing out annual volatility in capital requirements and allowing banks to plan capital returns more predictably. Analysts estimate that easing the ESLR alone could add 5 to 10% to bank valuations and free up to $100 billion in additional capital for deployment. With the stress test passed and regulatory relief on the horizon, banks are now poised to reward shareholders with substantial capital returns. While banks held back official announcements until early July, the path is clear. Wells Fargo is expected to increase its dividend on common shares by more than 11%. Bank of America plans to boost its dividend by 11.3%. Generally, analysts predict average dividend increases of 10 to 15% this year, with overall dividend yields averaging around 4.5%, a significant premium compared to the S&P 500's 1.8%. Beyond dividends, large stock buybacks are anticipated, with estimates suggesting buybacks could hit $100 billion this year across the sector. Citigroup alone has $20 billion in buyback capacity, and Goldman Sachs could repurchase $5 billion in shares. These actions are a testament to the sector's financial health and robust robust balance sheets. For investors looking at U.S. financial stocks, several major institutions stand out as strategic investments. JPMorgan Chase leads the pack with exceptional capital strength and diversified revenue streams across investment banking, asset management, and consumer finance. Its fortress balance sheet and significant buyback capacity make it a top choice for long-term growth. Bank of America, despite a comparatively smaller CET1 ratio, offers an attractive valuation, and its announced dividend hike, along with ongoing cost-cutting efforts, could unlock considerable shareholder value as interest rates stabilize. Wells Fargo, having navigated its past challenges, presents a compelling risk-reward profile, particularly with its projected dividend growth. Citigroup, with its focus on emerging markets, offers a leverage play on global economic recovery, and its stock, which has underperformed recently, could rebound as regulatory reforms take hold. Goldman Sachs and Morgan Stanley are also well capitalized and expected to participate in the capital return trend. However, it's crucial to acknowledge that no investment comes without risks. While the major banks appear robust, geopolitical tensions, from the Taiwan Strait to conflicts in the Middle East, could disrupt global supply chains and trigger market volatility, especially for banks with significant international exposure like Citigroup. Cybersecurity threats also loom large, posing risks to financial systems, though major players like JPMorgan Chase and Wells Fargo are investing heavily in this area. A sharper than expected economic downturn could strain loan portfolios, particularly in credit cards and commercial real estate. Speaking of commercial real estate, while major banks have largely adopted stricter underwriting and are avoiding volatile niches, many smaller regional banks remain heavily exposed, with some reporting CRE to equity ratios exceeding 300%. These regional lenders face a looming refinancing cliff as substantial CRE loans mature in a high-rate environment. Investors should favor banks with diversified portfolios and strong risk management over those overly reliant on volatile sectors or with high private credit exposure. Additionally, regulatory uncertainty, particularly legal challenges to Fed transparency reforms or delayed capital rule changes, could impact future benefits. In conclusion, the 2025 Federal Reserve stress tests have indeed given a green light for U.S. banks to aggressively deploy capital, signaling a new era of increased dividends and share buybacks. The sector's resilience, combined with favorable regulatory tailwinds, positions it for significant value creation. For income-focused investors, major banks like JPMorgan Chase, Bank of America, and Wells Fargo offer compelling opportunities. However, it's vital to remain vigilant, particularly regarding the untested private credit market and the uneven commercial real estate exposure among regional banks. The banking sector is poised for a multi-year bull run, but careful selection and ongoing monitoring of macroeconomic and geopolitical factors are key to navigating the opportunities and risks. If you found this breakdown helpful, make sure to like this video and subscribe to the channel for more market insights. We'll keep tracking these trends so you stay ahead. Thanks for watching, and I'll see you in the next one.